Hello, hello everyone. As I promised, I'm going to do the chapter 16 for the cost accounting. I'm quite busy in the first 1.5 months of summer. So finally, I got some time. I want to fulfill my promise. So I'm going to teach chapter 16, cost allocation for the joint products. Okay, so hopefully you have good summer, and if you have time, maybe watch this video and learn about this topic. So for this chapter, the learning objectives, I have provide mainly it's about how to allocate joint costs. Okay, there are different methods. So I'm going to walk you through the different methods using one example. So what is the joint costs? So we first want to cover the terminologies. What is the joint cost? So the costs of a single product process that yields multiple products simultaneously. So you have a single production process and multiple products comes out of it. Okay, so the cost for that production process, that's a joint cost. Okay, so in this picture, you have this raw milk. Okay, so when you're skimming the raw milk, that there are costs, right? You are using machine, using labor. So those costs, when you work on the raw milk, and when it comes to a point that you have different multiple products, skimmed milk, cream, butter, right? So this point here, okay, this is a point when the different products, the output become separable. So this point is called split off point. Okay. And then what is called separable costs? So in this example, you have three identifiable product: skimmed milk, cream, butter. Let's say you are going to continue to develop butter to make it to be a salted butter, right? So now you have to incur the salt cost, right? So this salt cost is only for the butter, right? It's not for cream or milk. So therefore, this cost is a separable cost, okay? So the joint cost here, that's for all the product. It's not separable, but the separable cost here right now, you try to further develop, process one of the product, that's separable cost. What are the product? Okay, product, any output can be sold at full product cost plus profit, okay? Or enables the company to avoid purchasing direct materials. So in this case, you can see you can sell the skimmed milk directly to a customer. So that's a product. The butter, you can sell them directly to a customer. That's a product. For cream, maybe you do not sell it directly to a customer, but this is the materials to make ice cream, and then you sell to customer, right? So in this case, the company don't have to purchase cream to make ice cream, right? So in this case, this output is also considered as a product. Joint products. What is joint product? So basically, the joint production process yields 2 or more than 2 products with a high sales value, okay, compared to the sales value of any other outputs. So at least 2, right? When you talk about the joint products, so there has to be at least 2 relatively more significant output products, right? You can call it joint product. Main product is just one, right? So the main product means among all the outputs, there is only one output that with a high sales value. Okay, so we call this output as a main product. Okay, this is all relative speaking, right, to the other outputs. What's byproduct? Byproduct would be, you have a main product. Okay, those are the things you really want, but the process also yield another product that has a relatively low value, low sales value. So that's called a byproduct. Scrap, that would be something that has minimum to zero value. Okay, and toxic waste, that's even worse. Toxic waste has negative revenue. It probably will cost you money to do the repair, to do the remediation, right? So byproduct have a low good value, scrap almost have no value, and toxic waste has negative value. Okay, so these are those terminologies when we speak of the joint cost. So the textbook have given us different examples. So for example, for the agriculture food processing, cocoa beans, okay? So when you process cocoa beans, what are some of the potential outputs you can yield? So that would be cocoa butter, cocoa powder, drink mixed, tannin cream, okay? So that's just one example, okay? Let's see the lumber, right? The lumber, when you process lumber, you get lumber of varying grades and shapes, okay? So the different part, right, may have different use, different value, right? When you are cutting the lumber, right, a different part. If you think about even you process beef, right, the cow, the meat, right, a different part when you process it have different value, right? The steak part is probably more expensive, right? Okay, so that's this one. So why we need to allocate a joint cost, okay? So when there is a cost, joint cost, and then you yield different product. Why do we need to allocate the cost incurred among the different products, different outputs? Well, for accounting purpose, right, financial reporting purpose, you need to maintain the inventory record, right? You need to know the cost, right, for each product. And it could be for insurance settlement, right? If some of the product went bad, right, and you have that insured, the insurance company will ask you, okay, how much does that cost you, right? And you need to have an answer, right, with reasonable calculations. And also customer profitability analysis, right? When you sell this product, right, you want to analyze whether this product is profitable or not. To know that, you have to know the cost, right? You have to know the cost. So yeah, you can see that there are different reasons for allocating the joint cost. Okay, so the joint cost allocation method, there are different methods. So mainly there are two broad categories. The first one is the market-based, okay? The second one is the physical measure, okay? The market-based, you allocate using market-derived data, dollar, right? Basically, this allocation, the proportion is based on a dollar amount, okay? So could be the sales value at a split off point, okay? So at a split off point, if you sell those outputs, right, what are the dollar amounts? And then based on each dollar amount, you know the total sales value, and then you can calculate the relative proportion and use that as the weight to allocate the joint cost. net realizable value, okay, and constant gross margin percentage, NRV. So these two are a little bit complicated. I'm going to explain it in detail using the example. Physical measures, so you allocate tangible attributes of a product, such as weight or volume, right? So in the example, we have the milk, right? So you could use volume, right, as one of the physical measures, right? Okay, so let's see. Okay, let's use this one example. I hope after we go through this example, you would know how to use the different methods to allocate joint cost. So this is the important part of this chapter. So suppose that you are processing the raw milk. You are processing 4,400 hectoliters, okay, raw milk, and that processing cost will be $345,000, and this is the joint cost, right? Any cost occurred prior to the split of point, that's a joint cost, and at this point you get two products. You get 1,000 hectoliters cream, and you get 3,000 hectoliters liquid skim, okay? So this is a relatively simple example. So you have raw materials and processing, okay? This is the joint cost. You know the total cost is $345,000. Now you need to allocate this joint cost between the two products, cream and liquid skim, okay? So how are we gonna do that, okay? So first, let's use the simple measure. We use the physical measure method, okay? The physical measure method, and we are going to use volume, okay? So now let's take a look at the production. So the process yield 1,000 hectoliters cream, 3,000 hectoliters skim. So now 1,000, okay, and 3,000 together, that's 4,000. So cream, the weight would be 1,000 divided by 4,000, 25%. And the liquid skim will be 3,000 divided by 4,000. That should be 75%. Sorry, here's a typo here, okay? So 25% for cream, 75% for liquid skimmed. Okay, so when we use this weight, and we know the total cost is $345,000, so we use the weight multiplied by the total cost. That's how we do the allocation, okay? So this is pretty straightforward, right? I hope it's not a challenge to you. Now let's take a look at the market approach, right? So the market value approach, first, let's go with the sales value of production. Okay, suppose you can sell cream and the liquid skim directly to customers, and you know the selling price, right? So the selling price is $155 per hectoliter for cream and $75 per hectoliter for the liquid skim. Okay, so what's the sales value of the production? So we're talking about the production, okay? The production is 1,000 for cream, 3,000 for liquid skim. So then the sales value would be, okay, the sales value of the production would be 1,000 times 155. That's the sales value of the produced cream. And 3,000 times 75, 225,000. That would be the sales value of the produced liquid skim. So when I add these two numbers give me a 380,000. Okay. So now I can calculate a relative weight. So the dollar amount for cream is 155,000. The total is divided by the total 380,000. So I have 40.97%, 40.79% for cream, and the remaining 59.21% is for the liquid skim. Okay, so you can see you first have to calculate the dollar amount, okay? And the dollar amount is calculated based on the volume of the production and the selling price per unit, okay? So here's a question, right? What if at the split of point, at that point, you have different product, right? What if you don't know all of the selling price, right? Because some of the product may not be able to be sold directly to customers before further processing, right? So maybe some of the output has to be further processed before they can be sold to customers. So nobody will buy that output at the split off point, right? So then apparently you don't have this selling price value numbers. So you can't use this approach. So then what are we going to do, right? So we are going to take a picture of this. So you have seen the left side of the picture. So suppose that, they don't sell at the split off point. They don't sell cream, they don't sell liquid. So I cannot just, right, use the approach we just used, right? So now, suppose they can be further processed. So let's say they use, for the cream, they will need $135,000 to further process the cream into buttercream. And you have 1,000 hectoliter cream, you are able to get 800 hectoliter buttercream. And now the sales value is higher because it costs more money, right? You can sell it for more money because there are some value added here. So now each hectoliters you sell it for 420 on the buttercream. Similar idea, you further process 3,000 hectoliters liquid skim into 2,000 hectoliters milk. And this process is going to cost $270,000, okay? And once you get the milk, you sell it for better process. You sell it for better. Instead of selling here $75, here you sell $305 per hectoliter, okay? So now you can see, now when I further process this, I have sales numbers, right? Because now you can sell it to the customer. But in the same time, I also incurred some of the cost, and these costs are called separable cost, 135,000 and 270,000. Okay, so now we are going to use approach called net realizable value method. Okay, net realizable method. We assume the product are not sold, they are further processed, and we know the cost, and we know the output of the new product and the selling price per unit. So what is the net realizable value before we do the calculation? So the net realizable value equals the final sales value. Okay, those are the sales value of the final product minus the separable cost. Okay, minus that separable cost. So in this case, the final sales value would be for the buttercream and the milk, and that will be calculated by the volume 800 times the selling price per unit 420. And what is the separable cost for the buttercream? Well, that's from the cream to the buttercream, there is this separable cost, 135,000. So I use the the volume of the final product, 800, times the selling price of the final product, 420. So that will be my final sales value minus the separable cost, 135,000. So I have 201K. So similar idea for the milk, I have 2,000, the yellow, times 305, light blue. So that's my final sales value of the milk, and minus the 270K, the separable cost. So I have 340K. So 201K, 340K, together I have total amount 541K. So now I calculate the relative weight, use 301 divided by 541, 37.15%. That's the weight we're going to use for the buttercream. And we're going to use this weight for the cream, right? And then the 62.85, we're going to use it for the liquid cream. And so this weight will be applied to the 345,000K to calculate the joint cost allocation. Okay. Okay, so now let's talk about a third method, the market approach. So that is the constant gross margin percentage of NRV, net realizable value. So basically, the whole point is the goal is to achieve a constant gross margin across the different product. Okay, so that's the goal. How can you do that? So you first calculate final sales value of production. Okay, so we have done this. So 800 times 420, so 2000 times 305. So these are the, so 800 times 240, so yellow times blue, and 2000 times 305, okay? And so then you figured out what is the total final sales value, and then you want to know the cost. Remember, there are two different types of cost. The cost before the split off point, that's the joint cost. That's the cost we are going to allocate, 345,000. So this is this number, right? The joint cost, 345,000 here to be allocated. And also the separable cost, we have 135K, the green color, 270K green color, right? So I need to add those two. So this is all my total cost. So when I add these three numbers together, I have 750,000. So then I take the difference, the sales minus cost, that give me the gross margin, 196,000. Okay, then I calculate the gross margin percentage by using 196,000 divided by 46,000. So I figured out my gross margin percentage is 20%, 20.719%. So now I'm hoping my buttercream and the milk, both product has this gross margin equal to 20.719. So now my sales number, we know 336K from 800 times 420, this number, and 61,000. So that's also coming from the top, 2,000 times 305. Okay, and now I want to know my gross margin. My gross margin is 20.719. So I use this one times the sales number. I can calculate the gross margin for each product. So now I take the difference between the sales and the gross margin. So I work backward to figure out what's my product cost. So for buttercream, it's 266K. For the milk, 483. So that's the product total cost. And I already know the separate cost, 135K. So I use the total product cost minus the separable cost. So the residual, 131. So that's going to be the joint cost allocated. Okay. So that's what happened here. Okay, so which method we can select? We have learned 4 methods. We learned the physical measure. We learned about sales value, right? And we learned about NRV, net realizable value, and we learned about the constant gross margin, right? So if the selling price at the split off is available, then you just use the sales value, okay, at the split point, split off method, okay. If the selling price at the split off is not available, and then you can use the net realizable value method, okay. So we know physical measures method is the most simplified method. And the gross margin method is also simple, but you know, some firm choose not to allocate. But this may not be the, but simplicity may not be ideal, right? It's probably not accurate, right? It's not accurate. Some firms choose not to allocate the joint cost at all, right? Okay, so that's for today's lecture. So I hope you enjoy chapter 16, and let me know if you have any questions. This fall semester, I'm going to teach accounting 3100 and 2400. So just let you know, if you are taking these courses, at least you know that I will be teaching these 2 courses. Okay, have a wonderful summer. Take care.